Today we'd like to cover the US inflation report and also the Federal Reserve's interest rate decision. Financial markets yesterday received two significant pieces of information, the first being the US inflation report and the second being the Federal Reserve's interest rate decision. So if we start first with the inflation report that was received yesterday and look at what the data told us. So as we've highlighted in these videos previously, we know that US inflation has been somewhat higher than what the Federal Reserve would like to see, but it's also remained stickier in that 3 to 4% range. This has mostly been driven by what we've seen through in the services channel rather than the goods channel. And that's been kept higher and stickier by three main components. We've seen stronger economic growth in the US than what had been anticipated. We've seen tight labour markets. And we've also seen wage inflation remain high, which has kept that rate of inflation sticky. Now, the report showed us that we saw a fall in both headline and core inflation, but it was also coming in lower than what the market had expected. So headline inflation came in at 3.3%. Core inflation, which are measures where we take out the influence of energy and food prices, that came in at 3.4%. Now, to provide some context in why that core inflation number is seen as a positive, we've not seen it this low since April 21. So we're certainly seeing the first signs of US inflation move in the right direction for the Federal Reserve to start cutting interest rates. Now, looking at what the Federal Reserve did from their meeting, they kept interest rates unchanged, so no change in that decision. However, what markets were looking at was the summary of economic projections that they released with the result. So that is the Fed's own forecasts on things like GDP growth, employment, inflation, and also what they see the future path of interest rates and how they develop. So looking at these individual components, if we put GDP growth and employment together, there wasn't actually much of a material change in the Fed's forecasts from when they did them last time in March. However, when we look at inflation, I think the Federal Reserve is starting to acknowledge that inflation has been stickier and growth outcomes have been better than expected. So they've marginally moved higher their expectation for inflation in 2024 and also 2025. And then that reflects through into their expectation of interest rates. So the Federal Reserve released something called the dot plot, and that essentially guides the market to how they see interest rates developing over the future. And what we have seen since March's forecast is that 2 interest rate cuts have been removed. So the Federal Reserve now is only expecting 1 interest rate cut this year. So ultimately, what does that mean for asset markets? Well, markets were quite pleased following the inflation report. We saw US bond yields come down significantly to the tune of about 10 basis points, which is quite a big move for bond yields in one day. And we also saw equity markets respond positively, up about 1%. But following the Federal Reserve's announcement, and they've indicated that there'll be less interest rate cuts, we actually saw bonds retrace most of that gain. So end of the day about flat to where they opened. However, equities managed to hold on to some of the gains that they had made that day. Thank you for watching today's video, and we'll catch you in tomorrow's episode.